both from the company side, people are starting up, people are looking to create businesses, effectively looking at the emerging sectors, whether it is emerging functional sectors or emerging technologies like, let's say, AI and climate and so on and so forth, right? And similarly, people are also kind of looking at vertical sectors, whether it is EV, whether it is energy, and so on and so forth, right? So with that, I think so. I run Fundamentum. We are a growth stage venture capital fund, and I'm joined by Vikram. Vikram, do you want to just maybe talk a little bit about yourself, and then we can get started with some conversation points.
Sure. So we are a pure domestic fund. We invest between seed to Series B. Series A, we are writing checks of about 50 to 60 crores. We like to work very closely with the founders. We don't invest unless we believe we can add value in companies. Broadly, three themes. One is India growth story. Second is India for the world. We are investing in Indian entrepreneurs catering to the global markets. And the third piece is the emerging and the deep tech. So there we are taking high-risk bets across all the areas of deep tech and emerging tech, including AI, ML, robotics, space tech, defense tech, climate, everything that comes under deep tech is what we are investing in. So we have made about 55 investments, managing active portfolio about 40 companies. We have invested in likes of companies like Purple, when it was very small, we took a 30% stake in that company. Clovia, similar story. Bluestone, which just went IPO very recently. Biryani by Kilo. Snitch, which was our Series A investment. And even Miko, which is a companion robot for kids. So these are some of the examples of the investments that we made.
That's a great portfolio, Vikram. So since the topic is on the emerging sectors, I will argue that VCs were always supposed to invest only in emerging sectors, right? And if you look at, let's say, last maybe 10, 15, 20 years, maybe a little bit more than that, the technologies which were emerging back then was, let's say, internet, mobile, cloud, right? And, when you look at globally, people have created really true value, large value, exploiting these kind of technologies, sectors, and so on and so forth. You have been investing in India for the now, last 13, 14 years or so, like great portfolio. How do you define, let's say, what is an emerging sector? And when you look at your own portfolio, how many what percentage of investment would be, let's say, in the emerging vis-a-vis, let's say, already emerged sectors, right? And how has the returns been both in emerging and, more traditional or more, let's say, mainstream sectors?
So typical VC fund cycle is about 10 to 12 years. And typical investment time frame is about 5 to 6 years, right? So you invest, when you start making your investments from a fund, you typically take about 3 years to deploy the capital. So if you're holding an investment for about 5, 6 years, so that's how the investments that you make in the third year, you'll be holding it up to the 9th or the 10th year of the fund. And effectively, when you're looking to invest in specific investment opportunities, obviously, your objective is to make investments in companies which are going to really grow exponentially, right? So venture capital, by definition, is very high-risk investments. You are okay to also write off a few investments. In fact, typically, globally, venture capital funds will have almost 50% of their portfolio as write-offs. In our case, we have about 20% write-offs in our portfolio. So obviously, there are phases, right? So that phase today, which is going on, and I think this is going to be much longer term, not just a 10-year time frame, is the phase of deep tech and emerging tech. And we believe that AI is fundamentally changing the way things are done. We've seen how it is already disrupting industries which are driven by content, which are driven by not just textual content, but also video content and audio content. And on top of that, any other things which are driven by research or knowledge-based industries, they are getting disrupted big time. Anything which is data-driven, Space tech, for example, is all driven by data, because eventually, when you send a space shuttle to the space, you are sending it for a specific purpose, right? So, and the purpose is to collect data in a certain area.
Yeah.
And that's all basically coming together to make sure that you're able to utilize the data to actually, um, uh, you know, predict things and do things differently. And that's how, eventual path is towards personalization, towards giving the end consumers exactly what they're looking for in the most convenient way, and the most cost effective way.
Right.
So that's the eventual goal, and that's exactly what is happening in every industry, whether it is financial services, um, healthcare, life sciences, retail, and so on and so forth.
But just to maybe go a little bit deeper into that thought, right? Let's look at what has happened. You started like what 12, 13 years back. That time the emerging technologies were probably internet was already emerged, right? Mobile, cloud. So when you look at your own portfolio, what percentage of your portfolio actually really took advantage of these emerging technologies, right? And I'm sure that you also made some investment which may not have taken advantage of these technologies as meaningfully, right? And when you look at your own return dispersion, right, how has that panned out to be?
So effectively, you have to balance your portfolio, right? I mean, if you have to return the capital that you raised from your investors. So in our case, in our fund one, we raised 240 crores. We made 10 investments, and we invested in Purple, which was 15 crore investment. We took a 30% stake in the company, and at that time, the online penetration of e-commerce was only about 1%.
Yeah.
And we're talking about a $30 billion industry, beauty and personal care. So we're talking about just $300 million industry. The story was that this is going to grow at a 15 to 17% growth rate as the industry itself. But the penetration is going to grow from 1% to 10%. So imagine the entire industry, becoming $60 billion in a 5-year time frame. And then 1% becoming 10%, which means you're growing from 300 million to $6 billion in a five-year time frame,
right?
Where even if you're a second player or a third player in that market, you could actually become a multi-billion-dollar company. So that was the basically story. So effectively, when you look at every investment opportunity, you're looking for a story like that,
right?
Where you're basically evaluating this. Is it going to become one of the top players in a market which is emerging, in a market which is actually really becoming large? And same thing is happening now in AI. So AI is disrupting sectors. So you exactly evaluate like that in terms of how is AI going to penetrate in pharma, in drug discovery, in space tech. So and therefore, what percentage of the market you can acquire over a period of 5 years, 6 years, and can this company become one of the top 2, 3 companies? So therefore, you take that back.
Is it fair to say then that, let's say, when you are investing in an emerging sector, emerging technology, so you're taking both, at least one, if not both, market risk and technology risk. So the output that you would also underwrite is significantly larger. On the contrary, when you are investing in a sector which is, which has a lower risk both on the market and technology, you are okay to write a smaller return because you also understand the risk is lower. Is that a fair statement to make?
Yeah, so I mean that's exactly what I was saying, that you have to balance your risk. So on one side, like what we've done with the fund 3, which is a 2,100 crore size fund, we've now allocated about 100 crores into extremely high risk investments. So we've done Dhruva Space, for example. We've done Morphing Machine, which is a semiconductor company. We've done BotSync, which is a warehouse automation. And some of these are like very early stage technologies.
Right.
And there's a chance that you could actually even lose your principal in some of these companies, given the nature of the stage of the company. But some of them have already started delivering value. So that's how you take that risk, part of the risk. On the other side, we've allocated a capital for Series B as well. So the companies which are already profitable. And then there are examples like Snitch, which was already profitable and they never raised institutional capital, and we put in money at the stage when they were already 100 crore top line with the decent EBITDA. So that, in the overall portfolio level, you are able to generate good returns for your investors.
So picking up from there, and let's let's look at it from an entrepreneur side, right? Because I would presume there are entrepreneurs here. If there is a way that we could actually provide them a little more insightful kind of guidance. When I look at, let's say, world's most developed market, which is US, right? And we look at venture markets there. In fact, not even venture market, even look at the public markets. Predominantly all large value creation is happening because of AI and AI related infra, right? Whether you look at 80% of value is being captured by big tech, 80% of big tech is all AI related infra, right? And whether it is Nvidia, Microsoft, all from a hardware and that's algorithm and so on and so forth, right? Do you see something like that kind of happening? And it may not happen necessarily in AI. It could be climate, it could be EV. But when you look at your own portfolio, when you think about all the conversation that you're having with the entrepreneurs, where is the big new profit pool creation will happen in India?
I don't think it's right thing to compare India and US from the maturity cycle of AI investments. I think US is investing big time, for example, in infrastructure building. They're talking about almost $600 billion just investing in their GPUs, in Texas, for example.
Yeah.
And I think when you're talking about those size of quantum of investments, I don't think we are there yet to compete at that scale. But I think we do have talent. The biggest advantage India has is the talent. And I think that's the reason if you're focused on solving India problems itself, that itself is a big opportunity. Look at the size of our population, look at the diversity of our population, look at the opportunity which goes beyond the metros, tier 2, tier 3 cities, the multilingual opportunity, and the opportunity lies across all sectors. In fact, consumer is a big opportunity. In fact, you take one problem which is not solved yet and think big on that problem.
You could create potential value.
You could actually create a pretty sizable business. And AI currently, you could actually use more as a tool at this stage of maturity curve of India. But at the same time, I think you could also think of creating a completely new product in AI, like what China did in DeepSeek. I think India has that opportunity now, especially because the funds have started coming in. A lot of grant money has been now allocated by the government. We're talking about 1 lakh crore allocated by the government for deep tech, which is a great positive move, and they want to co-invest with the private sector, with investors like us, who actually can understand the commercial side of it, working with the IITs, which is how our fund works. We work with all the IITs, IIMs, incubation centers, and then identify companies at TRL 1, 2, 3 stage also, and then support them at that stage, not just with grant capital, but also with mentorship. And that's what the entrepreneurs need in India. And I think it's at that stage where we are right now, where you would see next 3 to 4 years will actually become quite interesting in terms of new product development in the space. So I think it's quite exciting.
Picking on that, right? So as an example, AI does get talked about generally quite a bit, right? Because, especially when you look at, let's say, the US, China, those things have picked up in a big way. And I am absolutely with you, Vikram, that we need not necessarily compete. At the same time, it is also not right to compete. But when I look at, let's say, in emerging sector, there is deep tech, right? And the deep tech is a large horizontal. There are certain sectors or spaces where we have exhibited that there is a right for India to win. One example could be biotech sector. The other example could be space, right? Third is that I think there are, even in the defense, there are people, very interesting companies which are kind of doing some work on the communication layer, not necessarily only on the hardware layer, which was probably built a lot more in China and the other countries, but let's say the software and the communication layer. Have you seen some interesting companies? Have you guys invested in that sector? Can you talk a little bit about that?
Yeah, so we've taken bets, as I was saying earlier, in terms of completely new innovations. And I think semiconductors is a good area, for example.
Correct.
Where this company called Morphing Machine, that we've invested in, is actually developing a completely new processor. And and they're at TRL almost 8 stage, and if they're successful, I think they could actually disrupt the whole space quite substantially. Similarly, we invested in a company called Miko, which is a companion robot for children.
Right. Yes, beautiful company.
They are actually a very interesting play. And they were the first ones to actually develop a robot which was able to communicate with children. And this is even before AI became real AI. Actually, they started working on this product, and the product became a hit with the children. And majority or almost 90% of the sale actually is in the US markets. And now with the AI integration and a lot of other latest technologies, they are able to now obviously communicate even better with their end consumer, which is the 2 to 7 or 8 year old kids who otherwise are not allowed to use gadgets, etc. So I think so there are these kind of opportunities which are actually coming out from India, from Indian entrepreneurs catering to the global markets.
No, I can relate to the Miko story. I have young kids as well, right? And there was a time that they had a Miko toy, Miko robot, and they used to use it. And one of the reason why, like we as parents were very comfortable, primarily because it had bounded number of use cases. They couldn't have done things outside, so at least we thought this was a good use case, right? If at all we could be prescriptive. So no, I agree with you, right? And to the group. We have seen some very interesting even defense related companies, and as VCs initially, I don't think any VC would have looked at defense companies, primarily because they had a very high customer concentration, which used to be government, and I don't think a lot of venture capitalists actually understood government as well. But that has changed quite a bit, right, in the last maybe 5 years, 7 years, right? We have also seen some good IPOs kind of happening there. I also see a lot of interesting companies in the energy. I don't know whether you guys have invested anything there or not, Vikram, but that's also another very interesting area that I've looked at.
So we've invested in a company called Bijli, which is actually
Hindi for
it's a Hindi word, but it's interestingly they started in the US and got funded quite substantially in the US. It's basically smart electricity company. And they were
smart electricity meter. Smart meter, is that right?
Yeah, meters is definitely one piece of it, but I think there's a lot of analytics and data and AI that they actually use. Working with the providers of the electricity, and then giving them insights into how they can change their models to provide better electricity at a much cheaper cost. So it's a very interesting business. It's scaled up now quite a bit, actually.
Got it. Just switching gears, right? And Vikram, you and I were chatting about it while we were waiting for the panel, right? So, I started institutional investment around 8 years, 9 years back, right? And I have only seen global disturbances, right, in some way or the other. Either there will be wars or, trade imbalances and trade restrictions and so on and so forth, right? And it almost feels that we are now in a reverse globalization kind of trend, right? Because of one reason or the other. So when you look at your own, let's say, diligences, how do you now think about risk? How do you think about all of these factors? And I think what has been, when I speak with our investors, one of the things that has worried them the most is not that these things happen, but these things happen without really a notice, right? Whether it is the American president, whether it is something else happening in a different country, people will create a rule. That rule will be implemented overnight. So how do you think about all of this, in your portfolio and companies?
So obviously, when we do our due diligence, there's a huge amount of risk evaluation and assessment in terms of what can impact their revenues and costs. And if they have a huge dependence on exports, for example, to the US market, as an example, and this, especially sectors like jewelry, garments, and these traditional sectors, which are getting impacted in a big way from a tariff perspective, and we really don't know what's actually going to happen on the tariff side.
Yeah.
But there is a lot of volatility linked to exports to the US market, and I think we do look at these factors very, very closely from a due diligence perspective in terms of how their business will be impacted because of global or geopolitical factors. If they have dependence, for example, we had a company which had their manpower sitting in Ukraine, technology manpower on the East Europe side, right? Good. There's a very good tech talent sitting in East Europe, and this is even before the war started. They had started hiring big time, and interestingly, even today, many of these resources are still working with them, because I think, despite the war, you would actually see the good quality talent sitting in Israel. You actually see very good talent sitting in Israel, still working with the companies, and we've actually derived a lot of inspiration in our companies to develop tech products from Israeli companies, as an example. So
I'll push you a little bit on that, right? So you invest in very early stage companies, right? And it is impossible for a company to be able to kind of balance the risk, right? If a textile company, jewelry company, even software company, we don't know whether there will be a new tax on software that may come up or not, right? So it is impossible for a company to say that, hey, I will have all risk covered, right? But you are in the business of underwriting that risk in the early stage. How would you still think about it? The reason I'm asking this question is that I don't want at least entrepreneurs to take away a lesson that don't invest into textiles or jewelry, because tomorrow it could be another sector as well, right? So how do you think about it?
No, so eventually that's all venture capital is all about, right? You have to take risk, and unless you take risk, your returns will not happen. So that's the reason when you're investing as a VC, there is always that side of things may not work out, right? So you're investing at pre-Series A, Series A, and even at Series B, you still have huge amount of risk related to the team itself. Technology is a big risk, and your technology is still evolving, especially if you're in early TRL stages of the product. So there's a call that you take on the team. Eventually, you're taking a bet on the team and their conviction on the product and the market. So you would evaluate the founder market fit rather than anything else. And that the founders will go through maybe a few pivots.
Right.
If you were investing, or if you're evaluating Sachin and Benny Bansal based on only the selling of books model, and if you thought that the books are not going to sell and you're going to reject that investment, you will probably miss that opportunity.
Right.
But if you only invested in those founders and knowing that eventually this will scale to something else, you would make a lot of money.
That's a beautiful point. I think one thing that I always tell entrepreneurs who I kind of work with, right, is two things. One is that you have to genuinely think about founder market fit in a big way, right? And market is not only industry. Market a lot of times is all about business models, and could be B2C, could be B2B, stuff like that. That's one that the second thing I also tell people is that once you have chosen an industry, you will go through multiple pivots. Don't every 6 months, don't change an industry. You pick an industry, keep going deep into it. Even if you have to make pivots, pick that pivots into, because the compounding happens, right? Maybe I'll take one more question, and then if people have questions here, we could open to the to audience as well. I think we speak about moats quite a bit, right? Especially when it comes to, since we all invest into long term, right? So the business, even if business is sensible or scalable or scaling actually in the next 2 years, we have to probably will hold this asset for a long period of time. So the moats are important. When it comes to, let's say, emerging sectors, how would you think about moats? Is that because it's very difficult to think about moats in an industry which is not fully understood?
So eventually you have to be true to the problem you're trying to solve, right? So as long as you're committed to that problem and you are committed to solving that problem in a way that others have not solved, and your moat is really about finding the way that others have not even thought about. So I think as long as you're able to really build that, and eventually I strongly believe the real moat is execution. And I think eventually you can have the best of the best ideas.
Yeah.
You can have best of the best teams, but if you haven't executed it well, I think it doesn't yield anything. So for me, when I look at any moat, it's all about execution.
I'll tell you a funny anecdote on that, right? I was, of course, all of us will work with young founders and not so young founders as an example, right? So anytime I meet somebody my age and I ask them a moat question a lot more, because I tell them that, hey, speed may not be your the best advantage that you will have. It may be a significant bigger advantage for a 20-year-old or a 25-year-old, right? And similarly, when I meet a younger founder, I say, don't think about any other moat, because you should be able to, work much, much harder than, other people, and you should be able to. With that, if there are maybe questions, happy to take.
Take the questions offline.
Right. Okay. So great. No, thank you so much, Vikram. It was a pleasure to speak with you. Right.
Thank you so much.
Thank you.